Hey, Peter.
Hamza, how are you?
Hey, I'm good. How are you?
I'm good, thank you.
All right. We're just gonna wait for everybody to start rolling in. A little early. So how have you been, man? How was your day?
It's a good day. I am actually trying to shove about 8 days of work into 4 days of work. Uh,
Okay.
Taking my wife on a birthday trip on Saturday that is a secret to her.
Okay.
And so I will be, well, unfortunately, I will have my computer on the trip, but I'm going to try to stay away from it as much as possible next week.
Okay. Well, that's awesome, man. I'm happy for you. Where are you guys going? Anywhere special?
Well, I can't say it out loud because she's
Ah,
somewhere in the house.
got it. Got it.
But it's gonna be really, really fun. So I'm excited.
Okay. Well, that's awesome.
Hold
Let me
on.
just. We are. Times are good. I'm closing on a piece of property and 20 acres, and I'm getting ready for my own one of my own flex space developments, and it's proving to be interesting. The banks changed their terms on me a little bit, and I would have never imagined paying like six over 6% for something on a construction loan. I remember there were days when we used to be like, "Are you crazy?" Like we would be at like, low fives, and I would be like, "Are you guys out of your mind? Like, what are you guys thinking? How are we gonna make money in this climate if this is where we're at?" And now we're here, and this is where we are, and we're okay. We're all right.
Yep. I think as you and I were chatting about the other day, and you pointed out that, markets reach equilibrium,
Yeah,
and those that figure out how to operate in that new equilibrium are often uh, making enormous and creating enormous wealth,
yeah,
which is, we can't wake up in the morning and be scared about what might happen.
yep.
I mean, I know a little bit about you, but it's like you get up in the morning, you go, let's go make a deal.
Yep, let's go make a deal, man. And with us, we're deal junkies. So
Yeah,
we only get happy when we're making deals. If there's no
no,
deal,
that's exactly my mental philosophy as well. And you know what? It's chasing the deal is the most fun.
that is,
Uh,
what? I think the chase is really, I think you got it, man. The chase is really where we spend most of our time having fun, and then everything else doesn't really matter. The closing is actually the boring stuff.
right. Yeah,
Then we need to
that's when the
actually make it
attorneys come in
work.
and make sure you're not going to get in trouble.
Yep.
But yeah, it's figuring out the way that this particular group of land or land and buildings or markets can be figured out in a way that nobody else has been able to figure out. And
That's right.
that's the magic that I see in what you've been able to do. And I think
Yep.
your this education process is really cool. And in fact, I have an idea that I want to talk to you about, which we can do after this call or in the next few
Yeah.
days. But I think there's some version of what you do that can help your students. And once they reach certain levels, there's a mechanism that they can trip that will help them broaden their market appeal. And I've been using it, and I'm very, very happy
All right. Excellent.
with the
We'll
results.
we'll have a discussion. I'll put that in my notes right here. To have a follow-up conversation with you. Hey guys, good evening. Welcome to call number 21 or 22. I can't remember. This is recorded, so I'm gonna get in trouble, as I always do. But I think this is call 21. And today with me, I'm lucky to have Peter Quinn. Peter and I had a conversation earlier this week, and he has a very interesting story. He has a very interesting journey. Um, and I thought it would add a lot of value from you guys to hear firsthand from someone who has been just like me, by the way, who had been through the 2008 recession, and what that looked like for us back then, what that looks like for us today, how that is different, if at all. How, what are the differences that we are seeing, if at all, our journey from there on moving forward as well. So Peter, thank you once again for being here.
Hamza, that's really great to be with you and your team and the students that have pledged time and capital to learn more about how to sort of navigate this business. If I could, I'd like to take you back to the beginning of my real estate career and not, sort of belabor the small victories, but I joined what has become CBRE in 1980. And at that time, Global Banker Commercial, which is what it was known as, was a pretty small company. And, it felt like a fraternity every day when I was showing up to go to work. Learned an enormous amount. And for many of you on the call, you may recall that in 1980, interest rates were in the double digits. I got a loan on a residential piece of property in early 81, actually late 80, and I paid 13.5% was my interest rate for my home loan. So I spent 5 years at CB, fantastic opportunity. I got recruited away by a group of guys that broke off from Trammell Crow. Trammell Crow, for those of you who are unfamiliar, is a international commercial and residential developer based out of Texas. It was the most amazing experience to be surrounded by people who had already completed hundreds of millions of dollars in commercial development. And they gave partners like me, and I was very young at the time, the opportunity to run the entire program, soup to nuts. And it was an enormous responsibility, but it forces you to learn. And fast forward to 1990, and the world was sort of caving in from an interest rate standpoint. It became very difficult to locate capital for new deals. And what we said then was just stay alive to 95. And that was pretty much true. There was a period of time where the savings and loan industry was the biggest provider of capital for commercial and large residential developments in the market. And as it turned out, they were a little too aggressive, and it caused a depression in the marketplace that began really in the late 80s and extended all the way to 95. And during that period of time, the government stepped in with a group that they started called the Resolution Trust Corporation, and they took loans off of these savings and loans primarily, but Wells Fargo, Bank of America, Citibank, the largest banks in the world had bad loans on their books and needed a vehicle to get out. And they sold billions of dollars worth of loans into the private sector, many of whom I've known personally through my career. And it just created enormous fortunes for those that were wise enough to have capital at hand. Fast forward again, and really, I think the next really significant economic hurdle and situation was the 2007 Great Recession. That was the most significant economic disruption in my business life. And I was a partner with a large West Coast commercial development company. And our founder, a fellow named Bob Voigt, came to the partners and said, look, we're heading into some really rough seas here. And so we're going to stop doing new deals. and we're going to stabilize what we've got. We're going to sell what we can, but we're not going to be able to refinance our way out of these. So we need to be as aggressive and as careful as we can possibly be. And it literally, I think, it saved a number of my partners' personal homes and other unrelated real estate. If we had continued to do business in 2008, 9, and 10, it would have, been lost money because there was no money or value being created at that time. The marketplace was paralyzed. So you'd think that somebody who'd seen what had happened in 1990 to 95 would look at that situation in 2007. And I did see that. And I thought, we should be able to recreate the same sort of opportunity that the market presented in 1989 and 90, when the Resolution Trust Corporation came in and essentially seized all of these loans and sold them into the marketplace. And it didn't happen. It didn't happen. There was too much money, too much smart money in the marketplace. And we had, partners of mine and I had raised $100 million in order to go out and take advantage of this. And as it turned out, we needed $1 billion. And only those that had $1 billion or more in liquidity were able to really take advantage of the dislocation in real estate markets in 2007, 8, or 9. I put together a team, and we looked at every residential master plan development in Southern California, Northern California, Phoenix, and in the Las Vegas marketplace. And we knew exactly what the loans were. We knew exactly the condition of these lots, and the marketplace would not transact. And there were literally the properties. Let's take 100 lot subdivision in North Las Vegas, which was a marketplace that was devastated in the Great Recession. The hard cost into that 100 lot subdivision was $45,000 a lot. That was the cost to bring in your horizontal utilities, water, sewer, power, cable. It put in your curb and gutter and your streets, street lamps, and was ready to build houses on. They call that condition blue top lot. And blue top lots with a hard cost basis of $45,000 a lot were worth nothing. You couldn't get anybody to buy those. That meant that the land under those blue top lots, because somebody had to buy the land from a farmer or a land banking owner in these submarkets, that money was completely wiped out. But it took almost 3 years for the marketplace to really respond to that, and it took $1 billion in liquid capital to get the banks to pay attention and transact. So as Hamza and I were talking earlier this week about, well, how does this period in our business lives in the world, 2022, 2023, compared to the Great Recession? And honestly, I don't think it does. I mean, we're entering a phase in our economy where there is been tightening over the course of last year and continuing this year, but there is not the overbuilding pressure that is keeping values down. And I read every day about how commercial values are continuing in the early stages of 2023, are continuing to go up. Class A office buildings in Southern California are selling for more per square foot than they ever have been. New records are being hit. And these are buildings that are half empty. They might be 80 to 90% leased, but we haven't been able to get the employees to come back in the numbers that everybody would like. And yet the investment marketplace is looking at these buildings as irreplaceable. And that may very well be true. They may not be rebuilt in the same way that they have in the past. And industrial, well, we're in an industrial desert right now in the Western United States. There's just not enough industrial land to satisfy all the requirements that are out there. That's in the face of what many of you have read about big users like Amazon, who've given back millions of square feet in markets. I think they've given back over 3 million square feet in San Diego alone of big box industrial. But there will be users for all of that vacant space. And I predict that there will be a very low vacancy in San Diego and Southern California of investment quality, investment grade industrial real estate. And so when you find an opportunity in marketplaces that are constrained, and many markets in east of Southern California, in Arizona and in Texas are experiencing a renaissance in the smaller development, 20 acres, 30 acres, where you're able to put up buildings and satisfy the demand from entrepreneurs. And entrepreneurs are the fastest growing sector of our economy right now. They are out creating businesses and they need space to rent or to buy. And so that pressure is going to continue, in my view, through 23. And as we come out the back end of I think a very weak recession in 24. So I think it's an incredibly important time, exciting time to be studying your local marketplaces, to be an expert in your local market, to understand, that those banks that are going to be back in the marketplace and transacting, and I believe that will happen in earnest just after the middle of this year. I think it's a fantastic time. I'm very excited about it.
Yeah. So Peter, there's definitely opportunity. First of all, there's definitely a little bit of blood in the water right now. So, we're not like, if I'm being real, and from all the data points that I have with everything that's going on in land, I am seeing opportunity. Okay. I was seeing opportunity a couple of months ago.
Fantastic.
But I'm not seeing people throw land away the way they used to, or the way I did in 07. It's like, right. Yeah, there's opportunities. There's outside elements that are predominantly controlling the market more than, in fact, a recession, So it's people being right. more fearful, and they're like, you know what, we don't want to deal with this. We're just going to let it slide, let it go for now. And then we'll sell, and then we'll have the money, and we'll see where the market goes. It's not like, yes, we are going down from here, so I'm going to sell at a high and, be at a low. Also, what I'm seeing is nobody's really in a rush. So like when I'm putting deals under contract, especially land deals, it's not like, hey, you need to close in 1 week, or you need to close in 2 weeks, or we need the money right now. Which is something, by the way, which was predominantly what the opportunity that Peter is talking about was in 07, at least from my eyes, right? It was like, hey, we need liquidity. We need, at an institutional level, we call it liquidity. At mom and pop level, we call it, hey, man, we just need cash to like pay our bills, right? Right. And that is what we were seeing, and that is where the pressure was coming from. What are you seeing from that front?
So there's two strata of capital constraint. There's the institutional strata. Commercial mortgage-backed securities are dominant and predominant in that sector. A CMBS is the acronym that's used in financial circles. And CMBS loans, there are trillions of dollars of them out there, and there are hundreds of billions of dollars of those loans that are going to need to be refinanced in the next couple of years. So again, it's large capital players are going to be able to play in that marketplace. I mean, there will be smaller opportunities, but on the lower end of investment opportunity, Peter and Hamza form a partnership and went out and bought 20 acres of land. This is an example I'm creating here. And we went out and got this was 4 years ago when we did this. We got a adjustable rate mortgage, but it was fixed for 4 years. And then after that 4-year period of time, it would adjust and then float with the marketplace. So we have processed our property. We've entitled it. We've designed it. We're about ready to, in the end of 22, we were about ready to start construction. And we're looking at that interest rate adjustment that's coming. And we know what that interest rate adjustment is going to be. I mean, we're at 3.15% on our original loan, and it's going to go to 6%. And at 6%, that deal doesn't work. We're upside down, and the equity that we have raised and put in is not going to be able to achieve the rate of return that we had promised ourselves and our investors. And that partnership structure is going to be looking for someone to bail them out of that deal. And there will be a loss of equity. There may even be a collapsing of the debt structure, where you could buy a loan from a financial institution at below what they originally lent. And so I think there's just going to be fantastic opportunities, and it really happens at all layers of the development structure. It's in the 4-unit apartment building, and it's in the 150,000 square foot commercial industrial building. All kinds of opportunities are going to make themselves available.
Okay, so that is kind of the direction that you anticipate. Oh, by the way, for those of you guys who don't know what CMBS debt is, it's good when you get it, but it's bad once you have it. And it's a very interesting product. In fact, just going back on CMBS really quickly, I'm going to talk about my multifamily days. I had one deal. I still remember that deal till today because I freaked out when this happened. And as you all know, I exited to, a large group, a large Turkish group here in, who was coming to deploy capital here in America. And I had this one deal that was a CMBS debt deal. And CMBS, like I said, it's good when you get it because it's a little easier. It's less strenuous. Maybe the terms are a little more difficult, but once you get it and you're in trouble, that thing can collapse like that. And so I had this one deal almost, in the situation where Peter just described, where it was about to mature and I had to refi out of it or sell. Now, luckily it was under contract. I was closing in stages, and this was one of the later deals because it was a smaller deal. I think it was like a $9 million deal or so. And COVID hit. And the first thing that everybody was doing is they were pulling cash from their lines of credit. So everybody who had some type of a line of credit was pulling cash. Everybody who was, because you didn't know back then, you didn't know, is the market going to collapse? These people are not going to go to work. Who's going to pay rent? Am I going to be able to pay my mortgage next month? How long? How long will the bank allow me to not pay this note until we figure out? And back then when COVID had hit, literally we thought everybody's going to be out of work. Everybody's going to be home. No one's going to pay rent. We this online shift or this virtual shift or, these this type of situation was not really a thing. We would still go into the office every day. And so everything was in the unknown. It was the first time the world had experienced this. And I can tell you for a fact that it was the first time that I personally felt fear. Like when I would go to sleep, I would be afraid. Like there was other fear that I had in my multifamily days, which was like, if I go to sleep and there's a storm coming, I'm like, oh my God, how many tenants are going to call me tomorrow and tell me the roof caved in, or this is broken, or this pipe busted, or my toilet's not working. And, you know, those were things that would keep me up at night. But this was a situation that really, really kept me up at night. So my point is, and where I'm going with this is, CMBS is a product that you may use to structure debt for even your construction loans. However, you have to be very careful, and it is something that you really have to understand the risk reward in order to, you know, dive into a situation like that, especially now. Traditional financing, in my opinion, even hard money, may be a little easier to work with than CMBS. But as you know, as time progresses and as things happen, I think where we are getting at is that the opportunity is right. And one more little addition to that, on your Amazon, on your first of all, on your office deal comment, and then Amazon. So flex space is really cool because we actually target the office space as well. So not only is office losing people to homes, office is now losing people to flex spaces as well, because you have people who just want to park outside, literally walk into their office and have their operations kind of almost in sync with their backend right there, where they can make decisions live. So it's pretty cool to see how that, you know, how that is working out. Now, I did want to ask you, since you and I spoke about industrial, and you know, you had mentioned something about you observing a fund, an industrial fund that I think you didn't have the opportunity to be a part of, or you were a part of in a way. And I wanted to go and I wanted to dig a little bit into that, as to where that fund is now, and how that, or that syndication. I can't remember whether it was a fund or a syndication that we had spoken about, and you know, how that performed over the past couple of years for you.
So the fund that I and four other principals put together in 2008 was managed by a very well-known name in the commercial real estate investment world, and I'm still under non-disclosure agreement about some of the details, but huge company. The providers of capital to that was a $2.4 billion fund in total, of which we were going to have $100 million to use to go out and acquire properties. The boards of directors of, and I'll use names that many of you are familiar with, but there are retirement plans managed by companies like CalPERS, CalSTRS, Ohio STRS. Those are organizations that take money from government employees, and they invest it so as to create a return that will fund the retirements of the members that contribute to it. And the boards of directors of the 6 funds that had provided the $2.4 billion in investment capital to our sponsor said in October of 2008, I remember the meeting in Los Angeles, we will not allow you to invest $1 of this money until we figure out what the heck's going on. And so they basically froze all investment out of that particular fund, and ultimately wound up giving the money back to the institutions that had provided that investment capital, because there was no place to go create that 8% preferred return, the return that a investor would promise that a asset management company, and Blackstone or BlackRock would be a good example of that in today's world. They couldn't pay the 8%, 7% preferred return, which is the minimum amount that those investors were expecting. So they had to give the money back.
Yeah.
Was there another example that you and I talked about, Hamza, that I'm not remembering?
I think you had spoken about a friend of yours that started or did an industrial deal and then walked away with like a significant chunk of money. And it was a larger industrial deal from what I recall.
I'm sure that it will come to mind. I can't recall exactly what
Oh.
that transaction was.
So when it does come to mind, we'll get to that. What are you seeing as far as and this I'm going to be a little because I want this information as well, as far as our election. So elections are coming up, and you have two sides, and of course the one side wants to get reelected and the other side wants to get in, and the economy is a big part of that. And that's coming up November. It's pretty close. I mean, things are going to need to like head in the right direction if we're expecting, for example, a re-election, or they're going to have to get better once if the things are being promised to go up. So I find it fascinating because, and the reason I'll bring this up is because I've been here about 8 years now, and I've been through really one election, and I've seen kind of how that works and how the business cycle works towards that. And I'm just curious to see or learn maybe more about what impact you think that'll have moving forward.
Well, I think wiser men than I have said for hundreds of years, all politics are local, and the effect of politics have tremendous impact on local economies. So whether it's the Democrats that retain control of the White House and one or both houses of Congress, or the Republicans do, or there's some mixture therein, it doesn't have a great deal of impact on the local politics or the economy. It's we're going to be all paying for the trillions of dollars in money that was spent by the government, certainly for the rest of our lives and the rest of our kids' lives. But it's areas like, and by the way, everybody, I'm in Del Mar, California. It's in North San Diego County, and California is a really good case study to pay attention to, because we're losing hundreds of businesses, thousands of tax-paying families and adults, and they're not being backfilled. And for the first time in years, we have a deficit at the state of California. I think they're predicting just shy of 25 billion in deficit spending, and we're not allowed by law to spend more than we take in. So it's going to be interesting to see how they handle that. But the local laws that are driving businesses out of the state have a habit of moving to other states. And so, I think paying attention to what the state of California government does is very instructive about some things you may see in your own local marketplaces. I know that, and I'm not going to pick on Texas, but Austin, for instance, is a much more liberal marketplace politically and socially than many other major Texas metros. And so you need to pay attention to it because it will affect how policies are enacted and how they impact the way in which you conduct your business life and your personal life.
Yeah, I think all of you guys are coming to us from what I can tell, from all my flex-based tenant profiles. It's like, where are you coming from? They're like, oh, from California. Okay, well, look, I think, and and if I look at, and if I look at just broader picture, like I'm not really, big on politics. I don't really understand it, so I stay out of the way. I just, take care of what I need to take care of, and my life is good. So the way I look at it, just, without the noise, is that, hey, think about it. If I was a country, okay, and I have these elections coming up, and I have all these people who are suffering and struggling and whatever it is, I better make things good before I go. Or if I'm coming in and I need to take this guy out, I better promise that I'm going to make things good so that I can take this guy out. So either way, whichever way you look at it, things have to get better, for this to work. And as much as I think like the economy is not really connected, which it really isn't, it's all noise, and I get all that, but I do think that it's an important element, and I do believe that something's got to give at some point. This slowdown rather has created a lot of opportunity. We have not seen too much discount in product. We have not seen too much discount in concrete. There's a little bit that's giving up here and there, but we are not seeing things at the pace that we were in the last recession. Like the last recession, by now we were like, everybody's like done. There's no liquidity. The banks are not willing to work with you. I almost feel like the interest rates, believe it or not, like you and I were talking earlier that I just got quoted something ridiculous from a conventional lender. And had this happened just 2 years ago or last year, I would have been like, you guys are crazy. I'm just going to go somewhere else.
Right.
But, because the numbers still work, and the debt is relatively easily available. Yes, I understand that, the rates are no longer what they were. And like you mentioned that you paid 13% on your home at some point, and now here we are crying at like, 6%. The deals still underwrite, and they actually underwrite fairly well. They've been impacted, of course, because we got greedy for the past couple of years, but they still underwrite really well, to the point where I am in fact considering even deploying, or even like looking at unconventional financing now. And I don't mind paying the points up front, depending on, what type of leverage we're getting. And the funny thing is that it's available. Yeah, it's still available. They're still pushing, and they still want us to take on debt in order to be able to develop these things. Now, my question here becomes, do you think that we will see, so let's not talk about the interest rate because that's not going anywhere. I don't think that's going to happen over the next couple of years, but do you think that businesses are going to slow down enough to where we will see materials maybe now dropping in pricing because, people don't have business, like our suppliers don't have business? Is that a thing that could happen?
Well, there have been, pockets of disruption in supply chain that have impacted construction technology, and those I think are going to get solved. And I'm just going to focus on real estate. In the real estate business, it's just about predictability. So once sellers and buyers both recognize and accept that they can reasonably predict what the interest rates are going to be 6 months from now, then stuff is going to start happening at, I think, a very rapid pace. And I think opportunities are going to make themselves available. But because there has been so much discontinuity in the marketplace in terms of interest rates and their predictability, people are frozen. So I think, as I mentioned earlier, I think mid-year this year, we see a real break in that, and that sellers will respond to the offers that they've been getting from buyers like you, Hamza, who understand the numbers, understand what works and what doesn't work. And you're just not going to be in a position where you're going to do a deal that doesn't work. You're going to make sure that economic outcome is positive for yourself, for your investors, and ultimately whatever lending route you wind up taking. But somebody in the audience had asked about unconventional lending sources, and I'd love you to expand on that a little bit for me as well, Hamza.
Yeah, so there's a lot of what we call like hard money lenders that have now made themselves available, and they have investors that back them. And primarily, I would think they're either debt funds or some type of group of investors that come together and just lend money, and that is their business. Now, the way they underwrite deals is a little laxed. They may not need as many things as a bank, but of course, in exchange, there's a trade-off, right? The trade-off is the interest rate. So if a bank is telling me today, Hamza, you look like a nice guy, and I'm gonna, I think 7% is where I'm gonna put you at a 50, LTV, 50% LTV, and you really have to sit back and look at your rental income, and you're like, you know what, I think I can do better than that, and I'm willing to exchange that, okay, for maybe a 70 LTV at maybe 10%. I don't know what the hard money market is like right now. It's not something that I've explored. I've never actually done hard money, but I'm thinking, and these are just things. If the numbers make sense, it actually may be a better route to go hard money, because they they are still in the market. Those debt funds are still looking to deploy, and as long as the debt makes sense and the equity makes sense and your returns make sense, yeah, okay, you may not make that 25% IRR that you were looking for, but you know what, I think in these times when people are losing money and like losing their shirts, if I was sleeping easy and making 14% IRR with minimum equity, it kind of makes sense. It kind of makes things interesting. Like, instead of doing one deal while people are struggling, maybe I can do 4, and it's not CMBS. So you dictate the terms, and really your relationship with your hard money lender comes into play here, because they're not going to want to default on you. They may default on other people, but based on your relationship, you may not be the first prey in sight for them. Whereas CMBS, everyone's in the line of fire.
Right. No, that's absolutely right. And there are really interesting groups of investors who are interested in investing in real estate transactions, not as a equity partner, where there is no promise to pay back, but as a lender. And as Hamza said, they're going to get a outsized interest rate above and beyond what a bank might be willing to loan, but they're getting that at a higher loan to value, or LTV, and that allows them. And I'm studying a variety of deals that are being done in the market today. If Hamza can get a 70% loan to value and he has to pay 9.5%, but he gets to keep 100% of the deal, when he executes successfully, he's going to make a lot more money if he versus if he had to go out and get a partner and then a lower interest rate, because your project's going to cost what your project's going to cost. So if a conventional lender says, I'll give you 50% loan to value, and the hard money lender says, I'll give you 70%, but it's going to be at a higher interest rate because of the additional money that you're getting. And now Hamza only has to come up with 30% of
By the way,
project cost.
The 70%, I'm being very conservative. I'm getting a much better deal than that.
Yeah, that's awesome. That is really terrific. And you only get that by being in your local marketplace and talking to people that have interest in real estate investment. And the more time you spend in your local marketplaces understanding who the players are, the better prepared you'll be to execute when opportunities come to your doorstep.
Yeah. So, I mean, it's just something to think about. And if the numbers make sense, I know people shy away from it. In fact, I used to shy away from it, but now, just because they're so close together and the difference is really not that much. I mean, it is much, don't get me wrong, but it feels like I don't mind taking a haircut on my profit if you're going to make it, lucrative. And I think it is becoming lucrative at this point. So, something to consider.
Absolutely. We got a question from Rashid. Cost of construction coming down, material and labor, since people are slowing down on construction. It depends on where you are. I can't speak to areas outside of the Western US. A lot of pressure on materials. We're still not able to get cement, copper, steel. It's all in at the moment very short supply. Window systems. And everybody, Hamza, I don't know if you're seeing this. Everybody is busy. My architects are busy. The engineering companies are busy. The construction companies are busy, and they have a backlog that's going to take them through 2023.
Yeah. So on the larger deals, you're right. Absolutely. Everybody's busy. But I think with most of the members here, they are very local, niche down. So they are able to track the right, either general contractors or subcontractors. In fact, just, the last session I did, so I think that was Monday or Tuesday, and that's a session with me that all the members have. We were taking a look at a project, and construction prices were actually like what they were quoted. Now, we didn't get to look at the quote, but verbally what they mentioned is they were getting priced, I want to say like $100 a square foot, which is actually very reasonable for a completely like turnkey product. And they thought they could bring it down to $80. So I'm like,
Wow.
I'm following that like a hawk, because if someone can, get away with $80 a foot for turnkey with build out, that will be truly impressive in this market space for sure.
Yeah, I mean, those are numbers that are foreign to me here in California.
Yeah, I was gonna say those are Texas numbers. Like, you guys probably don't have anything below $200 a foot. Even
No.
$200 a foot is probably,
No, I have a friend and a client who needs 100,000 square feet of high bay warehouse space. He's operating on the border of California and Mexico, and we're being quoted over $300 a foot for basically a shell 100,000 square foot building that will be delivered in a couple of years. It's nuts right now.
Yeah, it is. It is. I'm seeing a lot of I'm seeing a lot of ears perking up on the hard money stuff after I mentioned it. Guys, just make sure, run your numbers, okay? You come in with a lot less equity, and the payoff is, of course, your return. Your ROI is going to be a little less, but then the reason for doing all of this is that you go in with very little equity of your own. You don't need to add too many moving parts to the deal. So the risk reward is there. It's something we can talk about a little more maybe in my next class, in my next session. I don't know when that is, but whenever that is, maybe I'll prep more on who good vendors are, and what that hard money life looks like. Maybe Peter and I will have a conversation, and I'll have maybe more info on what that life is like. And if I feel like it's something that maybe we can explore together, we'll definitely do that. How does that sound? That sound good? Okay. So we'll definitely tackle that soon.
And Hamza, after this call over the next few days, there are a couple of people that are doing some very interesting creative financing structures that you'll want to know about. So
yeah,
that's something you can share with your crew here.
Yeah. So we'll have a conversation, you and I, and then I'll update everybody from there. Okay. What other questions do you guys have? Let's see what people are curious about. Okay, it looks like everybody's pretty much caught up. They understand where the economy is, where the opportunities are. Peter, I want to take a moment and really just thank you for being here with us and enlightening us, with all the knowledge, all the information. Also, you and I have way more in common that I want to discuss. Other than this, I want to talk more about 07, 08, I'm a product of 07, 08. The reason I'm so vigilant and so I push forward and everything is because I had a very difficult life out of college. I graduated in the middle of the recession, and it was just very, very difficult for me to get anywhere, especially in a country where literally people were leaving because if you didn't work there, you had to leave the country. There was no way for you to really stick around. So it was it was a very painful time, and I think as a result of that we just become more resilient and we just push forward, and that's how we kind of are. And so I've always found that era, and especially people in real estate in that era, very interesting. Can you share some industrial market reports that you personally read? So do you have any reading material for the members that you could recommend, industrial or not, just anything that you think is relevant?
So I read a lot of different things. I love if you have access to CoStar. I'm sure that it's an expensive tool, but it's a great tool. They have fantastic commercial real estate, residential real estate related news stories all week long. It's the first thing I read on Monday because it has by region articles that I find interesting. Globe, Globe Street, is a fantastic source of commercial real estate news from around the country. Again, these are online. I read the Wall Street Journal every day.
By the
And
way, guys, Wall Street Journal, wake up every day. Trust me, it'll change your life.
And I of course sort of gravitate towards the things that are real estate related, but there's so much in the world, and the world does affect how opportunities get recognized. There's so many other great connected stories. And then on Fridays in the Wall Street Journal, they have a section, or excuse me, on Saturday, where they talk about books. And I've read more books during the pandemic than I have probably my entire life, on a volume basis. And it's been so fun. And you get people that you will learn to recognize, and you'll follow them, and you may respect the opinions that they've been able to share with their writings, and they'll have recommendations on things that you should follow up and read. And it's that's a great resource for sure. Barron's is a Wall Street Journal derivative that costs a little bit more to get subscription to that. And then the Financial Times, my son turned me on to the Financial Times. It is a fantastic source of international and domestic business news and reporting. So if you got to 2 of those a week, you'd be looking for time to do the work you need to do on a daily basis. So, sample stuff, see what you like, share with everybody what you're seeing and hearing, and you'll get a ton back in return.
Excellent. Perfect. Any books you would recommend? So last question, guys.
All right. So.
Oh, it looks like you have a list.
I do. So I have an Audible account, and
Okay.
I use that. I listen to it every day. So I just downloaded a book written, I think 50 years ago by a historian named Paul Johnson. And it's called A History of the American People. And it is, I've only read the reports on it. I haven't read the book yet, but I think it's a must read for people who want to understand more about America, who understand how today it is measurably different than the way that America has been in the past. And that's not a good or a bad thing. You'll decide for yourself. It's a great book. I read a really good book by a guy that some of you will find controversial. It's called Unsettled. Unsettled by Stephen Quinn. And Unsettled is a scientific look at global warming. And I found it to be, just a wealth of information. And then there's a political scientist, author, and very deep thinker, Peter Zeihan, Zeihan. I've read 2 books of his recently, The Absent Superpower and The End of the World is Just the Beginning. You will be, I would read that one first because it's so tightly in tune with what you're seeing on the international landscape today. It's amazing. And he literally just finished the book about 6 or 8 months ago. So his description of world history and economics and politics is fascinating. And again, those will keep you very busy.
Have you, Peter, have you ever looked at the U-Haul migration index at all?
No, I haven't, but I certainly am aware of it.
Okay, so just Google today, whenever you get time, it's fascinating, okay? And Google this, just write U-Haul migration index. It's on U-Haul's website. It's public record. You get all this information, and they basically give you all the trends on one-way U-Haul trips. And for the past couple of years, Texas has been #1 because the Californians have all been coming here, and but then after COVID, now you have Florida and Texas really fighting for those positions, because you have all the people who got tired of COVID and are running away, and they're like, you know what, Florida is it's a much more open place for them. And so of course Florida and Texas in general are top 1 and 2, but you have these fascinating places that are out of nowhere now coming up. And it's almost like, so they do it, I want to say, every quarter. It's an annual report. It's updated quarter. So it's pretty cool. Something really unique stood out to me, because I go into these rabbit holes where I'll go into the migration index, and then I'll start tracking cities and trends, and then go into, and Idaho, believe it or not, for 2023, I don't know why, is on a crazy growth trajectory. Now, I haven't figured out which headquarters, because what'll happen? What'll happen is like one big office will show up somewhere with like a couple of thousand employees. It'll trigger the migration index, and then for some reason it's skewed. So it's not really like 100% accurate, but it's pretty cool to see. You can kind of see where you have this influx of W2 traffic coming in, and then guess what? Those people need services. Those people need flex spaces. Often land is cheaper than anywhere else, because it's just out of nowhere. And if one person comes in, the hopes is either they expand, or there's more people like that who will get incentivized to go to the same place. So just a cool way to look at it.
Yeah, my daughter moved to Boise 2 years ago with a medical diagnostics company. They moved their call center up there because labor was cheaper. But the cost of living in the last 2 years is more expensive for my daughter to live in Boise than it was here in San Diego. But real estate is a lot cheaper, and people are continuing to come. So yeah, I think that's great advice, Hamza, to keep your eye on where folks are migrating to.
Yep. All right, Peter, it was good talking to you. I'll catch up with you after this in the next couple of days, and we'll have a deeper conversation. I really enjoyed this, by the way. Thank you once again. And thank you everybody for joining. And just like that, I'm going to end it. I'll see you guys on my next call. Take care, everyone.
See you guys. Thank you very much.